Well, moving on to the banks, in 2 weeks, we'll know whether the Fed is going to cut rates or not. Now, the markets have been fixated on this decision and got a potential signal yesterday after some dovish comments from two Fed officials. It is believed the Fed might cut interest rates by at least 25 basis points during a policy meeting at the end of July. Now, joining us to talk more about this and more from Columbus, Ohio, we have portfolio manager at Diamond Hill Capital, John McClain. Welcome. Thank you. So in your note, I actually saw that you had written that markets were fixated on central bank policy and were ignoring fundamentals. Could you walk us through that a little bit? Do you think there's an over-reliance of the markets on the Fed?
Oh, absolutely. And I think we really started to see that in the fourth quarter of last year, where the Fed's hawkish discussion really took a lot of value out of the market. I would say 75 to 80% of the drawdown that we saw in the fourth quarter was driven by the Fed. And what we've seen this year is probably 75 to 80% of the rebound that we've seen has been driven by a dovish Fed. And I think what we're seeing now is, the market is on edge at this point. You had both Clarita and Williams coming out yesterday, very dovish. The probability of a 50 basis point rate cut spiked meaningfully. It's already been walked back today to a certain degree. And I think where we're at right now is, yes, a rate cut is going to happen. It's the question of how many, how quickly, and you juxtapose that about what we're seeing on the fundamentals, right, both at the macro level and at the micro level. If you look at the macro side of things, global growth is slowing. If you look at China, we're seeing weaker data out of there. European PMIs are very meaningfully weak over the last 6 to 12 months. And we're starting to see on the micro level in the U.S. companies reporting second quarter numbers that are disappointing.
Hey, John, it's Heidi. So before we got the jobs report, everyone was pricing in about a 50 basis point rate cut. So we have a very, very important meeting at the end of this month. 25 basis points, 50 basis points. Are we really in so much of a slowdown that a 50 basis point would even make sense at this point?
No, I don't think a 50 basis point cut makes sense at all. Honestly, I think where we're at right now is what happened. What's changed from the Fed? Being data dependent, being patient. Going at 50 basis points to me is very extreme, and I think the market will initially view that very positively. But I think again, the market's going to come back to the Fed and say we want more. And it's at a certain point, the Fed's going to have to say, look, we think that the fundamentals don't necessarily mean that you should be cutting 3, 4, 5 times from here. Your starting point right now at 2.25, 2.5 is much lower than it was the last couple of times we got into a rate cutting cycle. So the Fed needs to be very careful with its ammunition.
So, John, how much of a beating do you think the market is going to take then? How much volatility can we expect if they don't get the cuts that they're essentially expecting?
Well, I think we're in for a repeat of the fourth quarter of 2018. So I think you could see, again, with the first cut, I think markets are going to respond positively. Maybe you get a couple percent higher from where we are right now. But I think if we get a second and a third cut, more importantly, and go into that 75 basis points of rates out of the Fed funds rate, where the market is right now, then sentiment's going to shift and people are going to start to say, what is the Fed seeing that we aren't seeing? Fundamentals are going to start to matter again, both macro and micro, and you'll start to see this, 15 to 20% decline in equities that we saw in the fourth quarter of 18.
John, Dan here. We're talking about the Fed. We're talking about Jay Powell and the Fed's impact on markets. And what's amazing amidst all this is how few people now in the last week or so, or the last 2 weeks, are talking about the trade war, which is still very much overhanging. And so you start to wonder what kind of juice we might see in the markets if we actually get some form of a deal. Although, of course, people don't really think that a deal, if we get one, will even look like the full deal that we once hoped for. But then on the flip side, how much of a negative hit it would be to stocks if it continues to play out so slowly and kind of if pessimism takes over in terms of the trade war. Everyone's just so focused on the Fed.
Absolutely. I think you're right. I think what is much more important at this point is the macro data that we're seeing, and that's driven by populism across the globe. That's driven by an unwind of globalism that we've seen over the last 30 years with trade wars and tariffs coming into place. And so I think the market is, to your point, expecting us to kind of muddle along here. And it's certainly not pricing in the trade wars not getting resolved and in fact getting escalated. And I think if we do see tariffs slapped on the additional 325 billion of goods, coming into the U.S. or coming out of the United States, that's going to have a meaningful implication on GDP growth for the U.S. Right now, the first wave of tariffs haven't really hurt as much, but I think this next wave will be very critical to slowing down GDP growth.
All right, we'll have to leave it there. John McClain, Diamond Hill Capital, thanks so much.
Thank you.